Spencer Hilligoss, welcome to the REI Diamond Show. It's a pleasure to have you here today.
Oh, thanks, Dan. Honored to be here. Really appreciate you having me on.
Yeah, for sure. So it was exciting. You have a pretty interesting background. Looks like there may have been some tech company corporate events for you that I assume you did well with over the years, at least in doing some research and stuff that I found out online. And that ultimately led to you putting together, founding, I believe, was it with your wife, Medicine
Yeah,
Investing?
that's right. Yeah.
Okay, cool, cool. So would you mind giving us a few highlights here just to kind of paint a picture of the background of a guy like yourself who started as an LP and then probably started bringing some friends in as you see, 18, 19, 20% returns come in, you kind of want to share this thing and then maybe that continue to compound from there.
Yeah, happy to. Looking back now, I mean, never would have thought if you had gone back in time and I talked to myself 20 years ago that this would be kind of the business and the life that we'd be leading. So, like we chatted up front, I lead Madison Investing, passive LP club alongside our investors. We invest alongside them in big assets that we like. And man, the landscape over the last few years in particular, Dan, such a helpful educational experience in so many ways. Mostly good. You get your learnings the tough way a couple times in this market landscape. But I would say, looking back at my corporate career in tech, so many of the principles and tough learnings I got from working in these five different high growth, high paced, Silicon Valley tech companies, man, thrust into leadership at the age of 26 and managing 200 people way before I knew what the heck I was doing, way over my skis. Those learnings, those frameworks, so much of that translates directly to how we look at and do what we do now, which is find great sponsors, commercial real estate sponsors, doing self-storage, multifamily, and beyond. And we vet them and make sure that we can feel like we could sleep at night before we go and deploy 50K or 100K or more into one of their deals or one of their funds. But truth be told, I used to be embarrassed to share that like my dad, he was a broker for 30 years in real estate. So I entered the business, quote unquote, I don't know, at the age of 6. I was eventually working open houses for him when I was a teenager, cleaning out fridges for properties that he was bringing to market, and just generally realizing, hey, maybe it's way more cool and fun to tell your friends when you're a teenager that you want to go work at tech companies than go work for your dad's real estate business. So it's like the universe's way of somehow saying, hey, look, we all become our dads at some point in some way, shape, or form, because here I sit now, back in real estate through a different lens. And I did found Madison Investing along with my wife, co-founder Jennifer. Uh, she and I decided to kind of walk away from our corporate careers back in. I left mine in 2019 because we had been growing this investing club, for a few years, and never did I think it was going to be something we'd grow to be hundreds of passive investors and investing in dozens of LP positions across, medical office, mobile home parks, self storage, multifamily, and beyond. And so this has been a really fun journey, and we keep the same rigorous approach that we did on our very first one that we invested in, where we kind of look at five parts of a vetting framework with every sponsor. We look at the number one, track record; number two, their approach; number three, their team; number four, the communications; and number five, their values. And there's a nerdy spreadsheet that backs up all these things with different qualification criteria that we like to use. But it's in the end, you invest, we take action, and we ultimately try to just approach it more like marriage than dating, because these are long hold periods. When you first get into these types of deals and funds, as a passive investor, it's a real head change when you're switching over from investing in like the S&P. You're investing in just stuff that is far more liquid, and then you're like, whoa, we're with the same partners for better part of 5 years, better part of a decade. That's longer than undergrad college, man. So it's been a really fun educational journey, and we get a chance to, with a little more flexibility in the schedule, to really focus on what matters now, which is being a great dad and prioritizing serving our investors. So that's probably more than you wanted, but just want to kind of give you the context of where
No,
we come
that's
from.
that's great. We have a lot to unpack there. Do you actually own, other than like the house you live in or a vacation home, do you own any other physical hard assets, real estate, like 100% just you and your wife, or is it 100% LPs in other syndications.
Yeah, we built up a modest rental portfolio initially, which is like the classic trajectory for a lot of folks, So example was the first, actually the first one we still own now was like a duplex on the West Coast here. I live in California in a little island called Alameda in California. Um, it's like 45 minutes north of us. Such West Coast pricing. This is before we understood how to goal set for cash flow. And so we went and paid for 430 grand for a duplex. It's appreciated hundreds of thousands of dollars, thankfully, but we were getting $200 a month in cash flow, which is not what you call a cash flow win. But it is educational, that's for sure. We drove around all summer just to buy that damn thing, and buy that in California. It's a win at least to get something that cash flows in general.
A
Um,
100%.
like we'll take it. But we then went on realizing our dollar had to stretch further, and we were going to tap out on capital if we kept on buying properties that way. So we went out to the Midwest and we built up to a modest portfolio of 5 single-family rentals. And economics were, of course, wildly better on cash flow. 60K average purchase price, which is confusingly and mind-blowingly cheap by West Coast standards. um, Average cash flow $250 a month. So we're sitting there going, whoa, we cracked the code. It's, of course, you go through the learning process on rental investment. I still believe in them. I really do think they play their role well in someone's portfolio as a tool. But when the turnover on one of those tenants happens every year, I mean, you're talking about crushing your economics for the whole darn year, right? And so where you get a piece of mail, despite the fact that you have a property manager you're giving 10% to every month, you still get that piece of mail from a county sitting out in another 1,000 miles away saying, "Hey, there's a couch sitting on this lawn, can't be there," and you're sitting there going, "You're like, why am I paying this 10% per month?" So yeah, so we kind of built up to that to that kind of modest portfolio before we realized maybe at some point down the line we'll go back to buying outright. But for right now, we have a couple young kids, and we strive to be as passive as we can be whenever we can be.
Yeah, I got up to I think like 49 or 52 units. Uh 10 or 12, maybe a few more single family, some three flats, two flat, um 15 and a 10 and a 6, something like that. So a bunch of
Nice,
units. Yeah, but then our main business is flipping houses and we did 259 last year. We
nice,
did 330 the year before that. We have an office in Atlanta, Chicago, and Philadelphia region, and we serve basically a 2 to 3 hour drive radius from any of those office locations. So we drive to do the deal. We have a lot of work involved to keep that fix and flip operation in that deal machine going. So I started to sell off that portfolio to free myself up. Now, I personally have been doing LP syndication since the bottom of the market started, which is, well, 2021 was still the peak. And I made I guess my first LP investment in 21, went heavy in 22 and heavy in 23, heavy in 24, I believe. Maybe it was 22 I made my first thing because it was about 3 years. Um, and I looked at the amount of effort, energy, and letters from the county about the couch on the front that I got from our shopping center that's in Las Vegas that I own a nice chunk of. And there was no letter because none of that stuff has my address on it at all.
right.
Um, yeah, and like magic money, it's just showing up every single month on the same date of the month now. It's been doing that for like 2 years. The distributions that are starting, and we'll have a nice windfall and big return of capital, and that will be like kind of the big chunk of our profit on that deal later. But just weighing the attention factor on that portfolio versus the LP has me shifting more and more into the LP. And I may kind of get to about that 6, 8 houses that are paid off. I have them paid off, the single families already. So I might just like kind of let sit there. If they go vacant, then sell them off.
That's
Not
great.
in a big rush like the others. But yeah, the point that I'm getting at for me at least is, and my listeners have heard me say this, single family rentals, buy, rent, rehab, refinance, um, apartment buildings. whether that's 2, 3, 4 unit, 12 unit, 15 unit, or 260 unit. Um, these are businesses that you're going to run.
That's
And I
right.
don't know about you, Spencer, but for me, I run the main business, Diamond Equity, the house flipping machine. I want to run that thing at its highest level because I owe that to my partners, and that's how we have the most transformational impact on real estate in the markets where we operate that business. So I looked at it and I thought property manager would keep everything off my plate. That wasn't the case. You know, the insurance cancellation comes in. Now it's like months of repairs to get insurance again. So I made that decision that I was going to get out of the residential rental real estate business, me actively, which is what a big portfolio is. And I think at the beginning, there's probably someone listening now, Spencer, and they're like, man, if I had 5 houses in the Midwest, that would just change, that would just
Maybe
change
change
my
my
life.
life.
Oh man, 250 a piece. Yeah, I'll get like 50 of those, but you don't recognize the actual cost of your attention to run 50 units until you get there. So,
Ain't that the
at
truth?
some level, must be nice that you had that lesson before you got to 50.
Hey, well, kudos to you though, Dan. I mean, that's an impressive machine that you built on top of it. And I have to share that like an important, a pivotal step in my learning journey, going down this rabbit hole in real estate was that the fifth tech company I went to was the largest, tech-enabled private lender for flips in the country. I mean, at the time, it was Lending Home, and then they rebranded as Kiavi. So I was brought in to lead their origination groups for, scale those until we were doing 600 loans a month, and that was me coming in as a guy who I'd worked for, high growth, hardcore places, but they were not real estate and they were not lenders. So I'm walking in going, I don't know what it means to originate, and I have to somehow go in and earn the respect of a bunch of very, very, very experienced, very salty, strongly opinionated team members and lead their team and scale them. And so that was really something, going through all the in-depth underwrite and getting licensed just so I understood the process. And so I bring that up because uh, it really gave me a deep, deep respect for the machine that is a flipping business. And the flipping business is as hands-on as it gets, incredibly profitable. But my goodness, you got to know what levers to pull. You got to know when to pull them. And also you have to just be expert level on risk management, in every way possible. So good on you. I mean, that's a tough machine to stand up, and it's an even tougher machine to scale, and you're pulling it off.
Thank you. Yeah, thank you. We're blessed. We have a great team. I think that's the critical piece there. And I didn't set out personally with goals to do what we've done. Um, and we've been about level in volume for the last 4 years, but we'll take that because it's a nice, strong volume, market leading volume. But it was never the goal. It sort of just happened, and we were like amazed. And new players continually joined the team who kept raising the bar. And we did some of that intentionally, some of that raising the bar. Some of that Amazon style leadership
Sure.
would be the inspiration there. But
Got to do it.
yeah, I digress. I digress there. So yeah, going into LPs. So I'm gonna touch on, and maybe you'll have some elaboration on this as well. I remember buying my first rental property, and there was a moment I had to wire in. I was paying cash, 60 grand for this rental property. I had to wire it in. There was a tenant in there, and the guy couldn't give me proof of payment. I'm like, why need proof of payment? God forbid I buy it and have to evict her. And he's like, look, she's paying. You either wire the money or the deal's off. And I had to like wire the money, right? I chose to wire the money. Luckily, I sold it for like 100 grand 5 years later. I evicted her. Then I evicted her son, who was like, but I did make money on the deal
It
in the
got
long
messy,
run,
but
luckily. Yeah, correct. House in Philadelphia. But I remember this like the moment, maybe the night before the wire, the moment that I was calling the wire in was sort of go time. And I was a man, I'm generally tried my best, just like all of us, to be a man of my word and stick by my price, no renegotiation. That's not our business model. And I said I was going to buy the house, so I pulled the trigger and I wired the money. And that's how I've treated every one of my LP investments. I think I have 5 separate, maybe even 6 separate partnerships that I put money in where I'm not the guy who has to does the insurance decisions and every contractor hiring decision. I'm, effectively LP, even if I am on the GP side, I'm not the lead GP who's making the majority of the decisions. Um, Now I don't feel that same apprehension as I'm firing the money off. I watch an operator, I know them. I will know mine for years potentially before I pull the trigger and send some money in. But on that first one, I had that same hesitation. It's like, all
Mm.
right, the returns look good. We did our underwriting. I mean, I'm in CoStar checking the price per square foot of other competing shopping centers before we bought. I'm checking the rents the best I can. I'm like, I did everything I know to underwrite the asset as if I'm going to buy it. And I'm an investor guy. So, like, I'm mitigating risk. Like you said, we're flipping houses and I know cap rates and I know how they're affected by interest rate adjustments and I know demographics. So, I think I'm probably more aware of many more questions than most LPs are going to ask. And I go
For
hunt all
sure.
that information down. I don't think that everyone's going to have the time or the resources to do that kind of thing. So, everything checked out. And then I told him, I remember there was this moment there where I'm like on the phone with the operator and I'm like, okay, I'm going to do this. And he's like, all right, I'm sending the wire across. So there was the apprehension at that moment where I had to like speak up and commit. But
Right.
then there was the same level of having to push myself to perform on my commitment to send off the largest single wire that I've ever sent off in my life at that point to
Yeah.
that operator. It was huge money, right? And it's like, oh my gosh, do I know this guy? Did I do the underwriting? Does he even own the property? Because there are horror stories out there where people don't own the property and they're raising
Sure.
money, right? And just complete con artists. And a lot of them we started to see, especially a lot on the social media, a big following. And turns out they didn't actually buy three or four of the 10 properties they said. They just walked off with the money. And now the FBI has those
That's right.
GPs, right? So all of those things sort of popped up. And at a point, you had to make a decision. You had to send the money. So I sent the
That's right.
money, right? I don't know. Did you deal with any of that on the first LP? Because for me, here's what else I'm facing personally. I've sold off the units. I'm supposed to settle out of 14 more in the next week. And as they've sold off, this like false sense of security, I make dramatically more money flipping the houses than I make from the rentals. In fact, they probably lose money because I'm renovating them and turning them over. I don't
Mm.
make any money from rentals. But there's a false sense of security in owning the rental portfolio where, oh, I'm going to be set. I'm set for my retirement. I better not eat the portfolio. I better not sell anything. I better not get rid of it. But I'm making the disciplined move to extract myself from the distractions to keep the main business running. So it's like a part of me that feels this trepidation about not owning the headache rental
Mm.
properties anymore, right? Maybe you could relate. You still own the duplex and maybe a couple of the ones in Midwest. Oh no, don't sell those. So part of going to the LPs is I am having to trust my partners 100%
Right.
implicitly with the money and trust they're going to do the right thing, sell at the right time, make the right phone calls, the lease negotiations with the tenant, adjust their prices on the self-storage facility correctly, not pay the contractor until the work's done. The list goes on and on and on and on and on because that guy is running a business the way that I am in my flip thing around running that business, that partnership that I'm going to become a partner in for the long term. Like you said, it's a marriage. I'm not going to date that person. So maybe you could touch on some of the emotions that LPs would
Mm.
feel, maybe from your own perspective, or maybe even from some of your friends and the club members and the community members who have invested for the first time in an LP deal.
Oh, highly emotional moment. And I really appreciate you sharing that, Dan. I mean, that is, I don't think I've met a single person or talked to a single investor who has ever said, "Nah, it wasn't a big deal." Like wiring, I always keep an even keel perspective on this once people start kind of, beating their chest about, oh, it's only 25K, it's only 50K. I'm like, I don't care what someone's net worth is. That's a big chunk of change. And, the first time we wired into a deal, it was in Alabama, it was a multifamily deal. Yeah, absolute pause, and over time your comfort zone expands. But I was just talking to one of our new members yesterday about this. This is a great example of like a common profile of folks that I often connect with, and they're kind of getting into the space for the first time as LPs, despite having robust portfolios in traditional equities markets, bonds, stocks, et cetera. And this guy is making hundreds of thousands of dollars a year, tech leader, And he's sitting there, at least he's self-aware enough to say, Spencer, I'm heavily weighted in the S&P 500, and I can't get my head around this idea of illiquidity. And I was like happy to hear him say that, because that is like one of the main parts of my educational mission that I take so seriously when I'm educating folks getting into this for the first time. Is like, they freeze, we all do, after doing months of analysis, hopefully, months of reading books and devouring podcasts, and they get to that starting line, they find a good deal, beautiful looking investment summary, got all the pictures, got the pro forma, they've called their sponsors, etc. And they get right there, and then they sit there and say, well, wait, like, I won't be able to see any money back from this, maybe some cash flow, but it's going to be 5 years. It's going to be 7 years. And that is a rare amount of self-awareness, because I always say, I recommend just getting into a deal at a small amount, because we as humans, we learn better when we have skin in the game, And so like when people
100%.
they start mapping out these 10-year journeys before they've invested in a single LP position. And I'm like, whoa, like hit the brakes. The quote that I got from a mentor of mine years ago, he was like, there will always be more deals, man. There will always be more deals. Like you don't need to think this is like the one day, the one chance to have a generational wealth moment. Got to do this deal or all else will loss and I'll fail at life. It's like, no, like you're going to have a chance to look at hundreds of deals if you want to over the course of a single year. So find one, carve out a little bit of a chunk, invest in that, start getting into the flow and see what it feels like, knowing you can't withdraw from this like a savings account. You can't redeem from this, even from like a semi-liquid type of account. And what does it feel like to get just a monthly or quarterly update, read those financial reports? Do you find that interesting? Do you like the way it feels to invest? So I think, to answer your question, the first time I invested, highly emotional, and very much emotional, I think, for some folks, to the point where I don't think these are a fit for some people. Like
100%.
like people who are, everyone has a different risk tolerance, and this is not a dig. This is just a fact. Like some people, uh, they really want absolute control over the moment they buy and sell a piece of stock they own. Good on them. I have looked at our portfolio, the illiquid portion of our portfolio, which is this, lots of alternative investments across all these great asset classes, and I have found it to be actually a boon, like a helpful thing, and also to be illiquid in some of these investments, because that way, it's a hedge, it's a protection against our own emotion to say, oh, but I got to take it out of this. Oh, I got to pull the ripcord on this. And it's like, well, but you don't. You just you did the due diligence up front. You vetted the sponsor. You liked the business plan. You looked at the market. You did all that legwork. Let it ride. Just let the thing ride, And so just to kind of answer your question, I think the way I mitigate that emotion, though, to mention this, Dan, is structure and framework and rigor. And I pulled that from one particular startup. It was the most hardcore early stage startup, A series startup I was at, and surrounded by these brilliant people, like way smarter than me, running circles around me academically and otherwise. But they always used frameworks to break down tough decisions, because you can't afford to sit around. You have to make big decisions quickly, and good decisions are typically made slowly. So how do you do that? Well, you got to have some kind of framework. And that's why I try to mitigate the emotional aspect of this stuff by just putting together a good looking framework that we can rely on. And does it work 100%? Of course not. We're not robots. But that's helped a lot.
Yeah, you brought up an interesting emotion, mindset, if you will, with your answer there that I wasn't expecting, and I'm going to touch on that here. There will always be more deals. And you said that, and I said, oh, yeah, that's so obvious. Of course, there's going to be more deals. But that's obvious to me because I'm sitting here at the seat of real estate forever and ever and ever and ever. I'm not the tech guy who was there with Mark Pincus going in on the Facebook, A round or whatever it was, where that was the deal of a lifetime.
Right.
And in fact, most people who understand investing read about it, study, from the public equities, right? Stocks, bonds, etc. There are quite a few actually deals of a lifetime where you have to back up the truck, go in heavy, and suddenly that's where you made your $100 million from $1 million investment, a hundred
Right.
x return, a 500x return. They don't just come down the pike every time you turn around. So perhaps some people come from that area, right? And that's a challenge because they're unaware of this endless flow. of LP deals. You're right. There will be another limited partnership that's going to invest in self storage, or it's going to invest in multifamily. Um, we're developing self storage ourselves right now, but the list goes on and on and on about these kind of, anywhere from 12% on the low end to 35% on the high end are returns that I know about that have transpired in the last 24 months.
Right.
Exits.
Right.
Right now, I think one thing that's important too, just to switch gears a tad here, we're in 2025. And from my view, the last 3 years have been the bottom of the LP market.
Yep.
There have not been exits. Deals are underperforming. When your friends are talking about their real estate investments, they're bitching because they're not, turning around doing these crazy refis and getting the hell out of them at these surprise. Oh, we were projecting 20 and we got 25% in 19 months.
Right.
The unrealistic top of the market type of era. But guess what, Spencer? I mean, my opinion, I'm patient. I chose the right LPs, and we're in projects that have significant demand or other factors that made those assets themselves. If we talk about your approach, right? I'm leaning on the track record of every one of my GPs that I've put money in, but what's the approach? And I would say that's the property itself is the
Mm.
approach. They're approaching that property with a certain business plan to turn that around. And I think the deals that, 2 years, 3 years, 4 years from now, we'll exit and we'll have our 25%. We'll be telling our friends about these and we'll be happy that we exited. We're like all bitching about the tax bill that's going to
That's
come
right.
that year.
Good
um,
problems.
yeah, but this is the bottom, right? So if we took the mindset of the stocks and the LP investors, it's like you had to go in and buy, what was it, probably a week into the COVID shutdown. That's when you had to buy
Yes.
almost anything. Yeah,
Yes.
Google and Amazon and a bunch of the other ones. You could almost have thrown a dart at the stock market
Totally.
14, 12 days in and won dramatically. I'm not saying you could throw a dart and hit a GP with your LP investment right now and win dramatically, but I think recognizing that right now is a tough time to make investments in real estate with the interest rates high and without these amazing exits over the last 24 months. And I just continue to make those investments. And what helps me too, I view it more as IRA money, Spencer, right? You've
Mm.
been putting money in your IRA your whole corporate career, and there's 300 grand, 500 grand there, and you can't touch it forever anyway. But you kept
Totally.
putting the money in. You didn't notice you were putting the money in because it came out of your check and it didn't hit your bank account first. You didn't have to pay taxes on it first before went into the IRA. So most of my LP investments that I've made and I continue to make, I look at it that way. I'm like, that's for my retirement. And I spread them around across asset classes, across markets in the country. And I have a major amount of diversity in the LP investments that I've made. I'm not just all in Texas where one hurricane comes and hits every one of my properties.
Right.
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 Um, but it's a same thing you said. It's a long-term approach that they are not liquid. I can't get out of them. So they're like IRAs to me. And I've also discovered that there's times where people want out, and there are sometimes buyers for the LP position. So like I have
Mm.
good relationships with my GPs where like if someone wanted out on, 250,000, maybe they're getting out and they're not getting returns. They're getting their capital back. There's
Just a
no
return.
proof.
Yeah.
Yeah, hey, I need my money back. It's been in there a year and a half. Okay, like there's probably another investor who likes it who would take you out of the deal. So I'm not trying to create a hailstorm of problems for the LP deals that you're in, but there I know of many people who have gotten their money back. The kids' college and something didn't come through with the loan, and they needed 50 grand. And a lot of times it's like you're in the deals with other wealthy people, and other people are like, hey, I got another 50 laying around. I'll go ahead and take them
Sure.
out. And yeah, so it doesn't mean they are not by any means illiquid and you can't get them, but selling them on day 14 of the COVID shutdown, that day would have been impossible to get out of any LP. No
That
one
is
would have
right.
stepped in and took you out of it. But you could sell your stocks for 50% off.
Yeah. I mean, one
Yeah.
thing that you brought up here that's so interesting and relevant,
Yeah.
I think, too, Dan, it's like you compare those exits from 2021, right? I mean, we were really, I'm so grateful and, that we were caught the wave, right? We got in, started investing, throughout 2018, around there, it's at 2017 and heavily throughout there, caught a beautiful wave. in 2021 of some exits, multifamily, self-storage. Now, we also, like, if you look at, okay, well, what's the realistic other side of that? So in the past year, 2024, four exits. We had four exits. And here's the difference between those four exits is we had two. I am so happy we got our capital back. And they were, variable rate loans on multifamily in 2024. If you're getting
Mm.
100% of your money back, you should be kissing the ground, um, which I am. And so on the other ones, home runs. And so I apply the principles of like, hey, let's go back down to like analyze this. Like, what's the root cause here of like why did that go so well? And in 2024, like how did these two deals, like one was a mobile home park, the other one was multifamily, and the multifamily, I just have to point this out because I think it's insightful. I think it's educational for how we look at deals now, which is it was a newer build. It was like an A class. It was multifamily deal, a few hundred units sitting out in Idaho, tertiary market. And this is like real path of progress stuff. But it was also the lowest projected returns going into that of any deal I've ever been in.
Wow.
So if there's not wisdom in that, I don't know where there is. So, and it ended up having a wonderful IRR, and so I look at that and I'm like, in this moment with this volatility out there, so many folks are looking for that flight to safety, and that flight to safety means newer products. That means like newer assets, and so those exits are not the same as 2021. So I think folks coming in right now, I'm sure you hear this often too, is like they'll talk to them if they've never invested anything as an LP and they're saying, "Oh, I want to get those 2 year, 3 year exits at that amazing multiple." And it's like, that was a different time. It's come back to earth, and this is absolutely a wonderful asset of asset classes I invest in, I believe in, exactly to your point, Dan. Like, it's like dollar cost averaging in stocks, like always be deploying in every context because some will hit, some will not, as long as you're taking those due diligence steps to de-risk whatever you can de-risk. But you can't, there was no single human on the planet sitting back in 2021 who had a forecast, whether it's a human individual or a large institutional firm, that had a 300 basis point increase in interest rates in their forecast. Not a single one. And so, you can mitigate some of these risks, but you can't control all of them. So I really believe moving forward, we try to just always be looking, always be investing, but just doing so in a prudent way.
I don't think I was forecasting 300 basis points increase, but since 2016, and you can go back and check, I've been scared to death of interest rate hikes on any LP deal. So you can go
Sure.
back and listen to my podcast archive, and I'm talking about the interest rates rising. And I came in 2006, so pretty much everyone who was in the business in 2006, 7, 2004, we've all been waiting for the sky to fall since then. Still waiting, waited all the way back up. Like that was our experience if you got in the business at that point in time. Um, but a lot of people made a lot of money taking the risk, right? It's like how many
Right.
gains do you miss out on if you don't get into the market?
That's right. Yeah. I mean,
Yeah,
and of course, you can always bet on a more optimistic scenario, on a more rosy scenario, or you can bet more conservatively. Of course, it is safer to just bet conservatively and miss out on some of the party.
that's right. What was the projected return on that newer build multifamily deal? Do you remember?
I believe
15,
that,
16, maybe?
yeah, it might have actually even been 14. I think it might have been 14. I think it ended up being like around at like a 23% IRR.
Nice.
Yeah.
I uh I coined a phrase called delusional optimism. Delusional optimism is probably what a lot of new investors think they're going to get in, right? Some guy wants to give you 5 grand to get in a deal, and he thinks you're going to pay him back 100 grand in 3 years. That's totally
Right.
delusional. In my context, I don't do the deal unless there's a hint of delusional optimism in my mental underwriting. I do not count on delusional optimism and us getting lucky to invest and hit the return. So if the projected returns are 14, that better be conservative and there's no delusion in there whatsoever. I'm not
Right.
delusionally optimistic in 14%. Um, on our self-storage deal that I'm building right now, we have a 36-month exit. It's fast. That's why I'm in the deal. It's fast. And the last one that was built was exited at the top. Um, Brand new Class A, sold to a REIT at certificate of occupancy. So it closed at 13 months, completely vacant. They had to throw $80,000 worth in signage. They had to yank it back off the building and put it in the trash,
Mm.
but they got their 190 or 210%, return, which was like an IRR of 89 or something like that in 13 months. And they had to like push the closing back so that they would have long-term capital gains on the deal. They had
Mm.
to delay the closing to sell the vacant storage facility. So my delusional optimism right now is, well, Trump's in office. If we can get the tax package pushed back through and cost seg and bonus depreciation, which are the tax benefits that may come with some LP deals, if that comes back into play and we get a few interest rate reductions while we're under construction through 2025, my delusional optimism is maybe we have a 13 or a 15-month exit and we get our chance to get our money back really fast. But my
Yeah,
money's out. I don't care if it's in there 5 years or 7 years and we have to like run the deal full cycle and build it out. I also invested because it's Lawrenceville, Georgia, was why I joined the team. I'm on both the GP and the LP there. But Lawrenceville, Georgia is a very solid, probably one of the best Atlanta markets for single family houses and development, that kind of thing. So there are like a lot of other reasons I went into that deal, but pulling the trigger, I'm looking for some way to get a little bit lucky, like you guys did, right? Hey, the lucky factor brought you 23% because there's a flight to safety and these cap rates are like amazing and someone's taking negative
totally.
leverage to get the deal done. One other delusional optimism example I would give would be you buy a warehouse in Texas and Tesla announces nearby that they're moving. And so someone pays you 2, 3 times what you paid within like 2, 3, 4 years. You had no idea that that could happen. But if your thesis is that you're bullish on industrial property the way that I am long term, because of onshoring and just the e-commerce, the need to store things, like it's not going away. And I think, in fact, with the tariffs and things of that nature, I believe we still have runway in industrial. Um, but that would be my final example of delusional optimism. That's where you get lucky, right? It's like, oh my gosh, they bought this thing in New York and they bought it for 4 million, they sold it for 14 million. Well, that was not a cash flow deal. That
Right.
was Prada wanted to own that property for their flagship location, something like that. Or the developer needed it for the air rights to build the other 42 stories of whatever he was building. And so they end up making this, outsized gain. You're never going to have that luck of the market if you don't get into the market, though.
I completely agree. I appreciate you sharing those stories though, Dan. I mean, the delusional optimism, like one of the, I think, more consistent themes, if I look back at some of the deals that have hit some headwinds that are, take out the interest rate risk from the past 2 years, which is severe, but like the other ones that have popped up. I was just talking to one of our new members who was thinking about going and investing and buying some rentals and in markets that I like, but they've also been taking it on the chin when it comes to insurance spikes, insurance costs, tax costs. Like these are things that I think on pro formas, if I look back at some self storage that we did in Texas and other places back in like 2020, I would love to have pro formas going in now. And this is what I told him. I was like, you need to put some multipliers on escalating insurance premiums. You need to put some multipliers on escalating property tax costs, depending on the market that you're in. And if it happens to be that it doesn't get to those levels, then that's wonderful. That's upside. Like if throughout the life of that deal, if 3 year, 3 year, five, it's actually not going up that high. Oh my gosh, that is amazing tailwind. And but if the deal pencils and you've already got those in there and the costs are escalating, you still like that deal, then go for it, man. But in the end, it's not fun getting bit by having a deal where you're like, wow, okay, how come that property tax spike in Dallas was not exactly forecasted as aggressively as we thought it should have been? You know?
100%, 100%. And most of my friends who are operators are forecasting that way with that built-in stress test the way you're talking about. Oh, it's a 1.5 multiple here by year 2, 3, and 4 in the spreadsheets that they're doing internally. And maybe their projections are more along the lines of what deal you said was a home run in 24. They're saying, hey, this is going to be like 14, 15%. One of my friends did that. His building, he got lucky. I can't remember if he bought it for 15 million or 30 and sold it for 30 or 60, but whatever it was, he doubled the property and it was a significantly sized asset
Nice.
because I believe, if I'm not mistaken, it was like some corporate buyer wanted their headquarters there. They like took it with the occupant. It was leased out, but like he got lucky on that buyer. So the returns were like 34, 35% or something like that. And
Nice.
it was like a 2 year turnaround selling in 2023 or 24. Like
That's incredible.
phenomenal deal. But if you were making your judgment based only on the IR of the deal and say, 14 is terrible, man. I don't go in anything that's not 20. Well, is it 20? Or did the guy not put the stress test on there? So when you
Right.
bet, like you said, on number one on the team and the track record, number 1 and 3 on your deal, the track record and the team may have achieved certain results and they project one thing on the front end and are like under promising over delivering. That's a good position
Yes.
to be in, but it's hard for the uninitiated to really grasp that if you're just looking at the numbers, I think.
Truly. Yeah. I mean, the one other thing I think has reared its head just to kind of talk about mitigation of risk on some of these spots. On the team, looking not only, we talk about track record, we talk about the approach, but in the team itself, uh, ensuring there's more than, this is simple stuff, but really important. Like, is there more than one GP? Is there, is there a single, person running that deal? And it's not the end all, it's like I won't necessarily walk away from a deal if it's just one person. However, it is so important to be able to ideally have some responsibilities distributed across two, three, or more individuals on a given sponsor team at the leadership level. Not even talking about the fact that they've got, if they're more, if they're not an emerging brand new sponsor, hopefully they've got a financial person in their staff, in their company, a controller, a CFO. My goodness, that would be a role that I'd, right now, I'm a stickler for that stuff, because if they can't produce clean, legible financials, I mean, that's a deal breaker right now. That's for sure. you know,
100%. Yeah.
like we were getting really close to working with a storage sponsor the other day. A really great team, just good guys, and I like them a lot. But my heart sank when I looked at all their, do my due diligence. I was looking at the financial property by property, good looking assets, good looking markets. And then I look at the pro forma for a fund and I was like, I'm not the guy that's so uptight that it's like, oh, they've got one font type here. It's Helvetica on page one and it's Roboto on page two. Therefore, I'm going to walk from this incredible deal. But it has to be legible, and it has to be like, at least you have to follow the story of the business plan as translated through a spreadsheet. And I couldn't really do that. And so looking at the team, can the team itself and that GP team produce just good financials? Do they have some shared responsibility, hopefully across multiple individuals? Because sometimes you've got, leader visionary. Maybe you've got a person who's ultimately CFO. Maybe you got a person, if they do heavy value add or they do new construction, maybe you got a construction expert. You got that deep expertise on the real estate front. But we go a lot deeper on that front now, I think, with that team. Just to ensure that we know that if one person, God forbid, what if they get hit with a terminal illness? What if they get hit by a bus?
Yeah.
Like life happens, and you don't want to have this floating large tens of millions of dollars deal or fund sitting out there without a person to be able to steer the ship.
I'm a little nervous in some of mine on that lack of redundancy, but we'll knock on wood and
Yeah, me too.
I digress. Are there one or two other underwriting of the deal from an LP perspective, tips, tricks that you could share here before we get to our wrap up section?
Sure. I think we'll do one that's more qualitative and then one that's just firmly more quantitative and firm. First and foremost, uh, I call this thing failure response. We talk about track record. You want to see full cycle exits, of course. Now, I get more nervous, Dan, if I'm talking to a sponsor and they have a perfect track record and they've never been through some form of professional meat grinder, not to be too grim with the figurative talk here, but like if they haven't been kicked in the teeth entrepreneurially, um, and they can't, if I ask them a question like, walk me through a time that a deal didn't go well. What happened? What'd you do about it? How'd you navigate it? How'd you communicate with your investors? You want to show me an example of how you did it? Um, that gives me immense pause because in the end, everyone's got a plan until they get punched in the face, as the Mike Tyson quote goes.
Yep. Yep.
I have yet to be in a single deal where something crazy doesn't happen in some way. And what matters most is even keel, confident judgment. And at the moment that a person is hit with a new scenario, that judgment's going to be compromised. So like I just want to make sure that they can actually like I sit there and I kind of test for that. And we're just getting to know each other when I'm talking to a sponsor. It's not like a hardcore job interview, but it's an interview all the same, both ways. And so that would be one of them. The other one would be, I mean, clearly we have to talk about like the financial structuring of the deal. You know, we always make sure, okay, are the fees that are involved just reasonable and within market norm? Can they be justified? Because I think sometimes LPs tend to go read one blog or hear one podcast and they say, I never want to see a single acquisition fee over 2%. And it's like, well, like any other fee or financial incentive in anything in business, if it's justified, that makes sense, right? What if they're doing extraordinarily heavy value add, you know, like a gut rehabs and stuff, and they're putting some of their construction costs and their upfront costs into that acquisition fee? I don't know. I'm just bringing that up as a random example. That could be justified, but of course, we want to see reasonable fees on acquisition. We want to see reasonable fees for asset management, and most importantly, we want to see that there's going to be protections in there for LPs too. Is there a preferred return? Is there a split, a profit share, or a promote for the GP that is incentivizing the right behavior to keep them motivated to keep driving a great project through to completion? Because in the end, you don't want to have a GP also that is not motivated by year 3, year 4 out of a 7-year hold period. I mean, that's not a win for anybody. So sometimes when people will say, new LPs will say, I can't believe the GP is making fees. And I'm like, okay, let's just take a step back here. It is an immense amount of work to go find a deal. It is an immense amount of work to compete for that deal and put it in front of people. So educating, I think, on how much work it takes to go and do that is also very helpful. Like front end to manifest that deal out of nothing and then to drive it through to completion. Aligned incentives matter.
Yeah, I love that part about the profit share. And at first, so I'm in deals where the capital stack is receiving 30% and the GP will be gaining 70%. But that doesn't start until the capital has been 100% returned, either through distributions or through a refinance or a sale,
Okay.
right? Then it's 30/70. Um, when you do the math on the exits, we're actually on the market, that still is doubling your money. So an equity multiple of 2 when it goes well. So I've noticed that there are some operators who get these unique unicorns of a deal. The one that I mentioned earlier, where the guy was 15 and he sold it for 30, or it was 30 and he sold it for 60, whichever one that was a 30/70 split, 30% to the LPs. And for you and I as an LP investor, my God, that's horrible. How unfair is that? Is he out of his mind? Like, but that was a 35 something percent return. And it's
Right.
just this guy's track record and his ability to select just the right project and execute on it that nimbly, that he's able to deliver these outsized returns with such a small percentage of the actual deal going to the LPs compared
Yes.
to what I kind of prefer, which is an 80/20 split, where it's more along the lines of private equity deal, meaning it's a 20% ownership. And that's what the GP has is his 20% share, and then 80% is going to the LPs. But Spencer, sometimes you need to do the math 20/80 so that you're getting to this 1.8 equity multiple or 2. So the deal is not quite as much of a smoker as the
Right.
one that the other guy did on the other end. So there's a lot more variables that could come into play into every single one of those deals. And as I'm like reaching a new level of maturity and understanding, it's like, okay, um, do you want 80% of a marginal, okay deal where that works? Maybe I do. Maybe I like the market that much, and that's exactly what I want. Or
Depends. Yeah.
some super small little slice of this smoker of a deal that's going to go well and it's going to happen quickly. And maybe there's a refinance, I'm getting my cash back sooner, or there's other reasons why I do the deal, like the tax benefits in there that got me into the other one.
Totally.
Um, so yeah, the 50/50 split, the waterfalls. I mean, there's not really a one size fits all, at least for me, where I'm going to say, hey, I'm looking for, 50-50 or better to the LPs. I kind of do actually say that when I'm talking to people. Maybe that's a bit of a negotiating strategy, and I'm writing larger checks than most LPs. So sometimes I can get a Warren Buffett deal from some of the operators that may not necessarily be available publicly. Wishful thinking, I guess. We'll
No, that's
see.
great.
Yeah. Cool. So let's shift gears here a little bit. You've had a very interesting path through real estate and to the seat you're at now with Madison Investing. So I'm curious if there are any book recommendations, one or two maybe, that are unique and not necessarily like, hey, this is what we tell everyone who gets into real estate. What have been interesting books that you recommended to people who were, let's say, in executive roles in the tech field when they asked about what you were doing?
Oh man. I mean, gosh, when I first got into it, I think I read something like 24 books in the first 18 months, and way more than anyone needs to do. And I'm not a fast reader. But the best book for me, nothing to do with real estate, is Essentialism by Greg McKeown. And that book, it arms you with the 5 ways to say no in service of higher priority, and also while keeping your social graces intact. And the story as it goes at the very beginning is like it opens up with a guy in a delivery room who's having a baby, and an executive is like having to duck out and take a call and be on a meeting, right? And
Mm.
everyone's got the same 24 hours in a day, and so in the end, that book was a real game changer for me. And I've gone through it 3 times at this point in my life, and it continues to bear fruit every single time, because it doesn't feel good to say no to a coffee or someone says, hey, you want to come to happy hour with us? And it's like, well, no, you don't want to be that jerk. But at some point, there is a higher calling, and you have to, maybe in bursts, maybe for that one week, maybe for a whole 6 months focused sprint you're on, you got to find that time, man. So that book really helped with those tools.
Very good. Very good. It was exactly the one I'm looking for. I like that. Crown Jewel of Wisdom. You're going back to, what was it, 2018 is your first LP investment. You know now everything that has come from the last what's that, 7 years or so. So
Mm,
what would be the crown jewel of wisdom you would go share with your younger self back in 2017, 18, or maybe it's even way before that now, and
sure.
you choose a different point because you're trying to put a foot up the younger Spencer's behind to do something a little different, knowing everything you know now, what would that be?
Yeah, 2 things very quickly. I would say on the real estate front, I mean, fixed rate debt or bust. You know, I think that's got to be that one. Otherwise, more broadly, every one of us, I look back at career and corporate real estate, life and beyond, and approaching every relationship is one that approaching that as the long view of building something that can be lasting. And I mean that like, and you step into an office, you have a W-2 job, your coworkers, you can be very transactional if you're not careful. And in my 20s, I think a lot of people are very focused, very career driven, very thinking about themselves. That's normal. That was certainly me. Um, but man, was there some missed chances just to kind of keep a relationship going. I mean, not for profit, but just because the universe always kind of comes back around and gives back to us the more that we pay it forward. And I think that is something that really, really is helpful, regardless of the career path that people choose.
Solid. What information, before I ask my final question, where can listeners get more about maybe Madison Investing or you, Spencer?
Yeah, over at madisoninvesting.com, folks can just request an invite to join our club, and they will have to talk to me though.
Nice. So my final question that I ask every guest on the show, what is the kindest thing anyone has ever done for you?
Oh my goodness. Second chances. I think that second chances are gifts. And there's a mentor who I've worked with at 3 different companies. Got up with them last week, and without going too long-winded, I'll say, I quit my first job out of college a year and a half after that. I was making great money, and I did it because I wanted to go travel the world because I'd never done that. That's like as he calls it, my eat, pray, love moment. Um, I had an absolute blast. I went into a bunch of debt and realized that after good year of doing that, I was like, I think I need to go and get serious about life. And so he gave me a second chance, and that became a job where I went in as a customer support rep, making, $8 an hour or something like that. And then eventually within 5 years afterwards, I was running an entire facility of 200 employees, and like that was never would have been possible without a second chance.
Very cool. Had some of those myself over the years. Spencer, I really appreciate your time today. I got pages of notes. We took this in very unique place. I feel like it was my own LP therapy session where I've had my own breakthroughs during this very hour today. So I appreciate you coming on the show.
Yeah, well, thank you for sharing your journey as well, Dan. I mean, you have so many stories and pieces of nuggets to tell. So thank you.